Right, it's 12:30. Let's get this going. Thank you again for attending. I'm assuming at this point you've read through the risk warning, so I'm going to jump through to our next screen. So this is what we're dealing with, trading in volatile markets. We could be looking at a fairly volatile open today. Just as I start this, Russia is promising to blow US missiles out of the sky in Syria, and Trump has tweeted that Russia should expect missiles to be fired into Syria. So a bit of a march to war taking place at the moment. Typically not great for sentiment in markets. So we might see, in addition to the increased volatility that we've seen over the last few days. So specifically on trading here, when market is volatile, daily price swings in the market are larger than usual. So a high volatility environment brings with it greater opportunity, but also risk. So this presentation is to help learn how to prepare for, understand a bit more, and adjust trading techniques to high volatility. And this is some of the topics we'll be covering today. Just is it helpful? What is it? Where does it come from? How do you measure it? And then just again adjusting your trading to fit it, including the use of a couple of worthwhile indicators to measure volatility, both for broader markets and specifically for the market that you're trading. So just as a quick refresher, market volatility is a statistical measure of the dispersion of returns for a security or market. So the general idea here is that it's the amount of movement in price given within a certain period of time, and how that differs to the typical amount of movement you would expect in that piece of time. If you're seeing a lot more movement, volatility is high. If you're seeing a lot less, the volatility is low. Now, where does it come from? So often you'll find that there's a fundamental trigger to the kickoff in volatility. So a recent example being that we had much higher than expected wage growth data in the US in January, and so when that data was released in February, it caused a bit of a shock and actually triggered the correction in equity markets. So that was actually an example of something that could be pre-planned for. Probably the extent of the reaction was hard to gauge, but there is an economic calendar. Likewise, there is a corporate earnings calendar. So these are all known sources of potential volatility that you can prepare for. So sometimes these are just short-lived price moves. That's not necessarily a reflection of volatility, but if it is something significant which will change the attitudes of traders over the forthcoming future, then that's actually something that shifted the overall volatility. We'll talk about it in just a minute, that obviously there are a few indicators that you'll use which count, say, 14 days or 30 days in terms of an average of what the volatility has been or what either will be in the future. But you also have unscheduled news like natural disasters. You know, I was just talking about the political controversy that maybe is stepping up a little bit at the moment. Obviously, the what's turning a bit of a kind of hot situation in Syria, with obviously two superpowers on either side of the argument, is a source of concern. Maybe you could have prepared for it, but it's not exactly something that's in the calendar. And then the backdrop to this is that normally the reason for the high volatility is not actually the news event itself. It's really the sentiment of the market preceding the news. And normally that high volatility comes after a period of complacency, where the investors were just very confident about economic growth, for example, very confident about the earnings outlook, had brushed off various sources of concern, and finally one source of concern was the straw that breaks the camel's back, and then causes the spike to higher volatility. And so in terms of the price, you can see this manifesting itself as a tight price consolidation will break out into a high volatility trend, or you can see a steady, easy trend will suddenly turn into a choppy range-bound environment, or even a sudden reversal of the trend in less frequent situations. So is it helpful? Well, there's no free lunch on knife, unfortunately. This is no exception. It can increase the reward that you can get from your trades because there is more price movement, but there's also more risk that goes along with that. So just to kind of describe, if you like, some of the characteristics of high volatility, just to kind of give you a feel for what you're looking for here and what this term actually means for your trading. It will increase the speed or reduce the duration of how long they take of certain price moves. The net effect of that is that profit targets can be reached sooner. Clearly that's a benefit. But there is a bigger chance of being stopped out as well, because obviously enough, price is moving more in a certain period of time than it might otherwise have. It might run through what might have once been a reasonable level to place a stop, before then carrying on to the profit target, all within perhaps the same period of time, but there's just been bigger price swings. So what you can also see is that price will see will correct by larger amounts in a trend. So you see that particularly, the classic is the dead cat bounce in a bear market. You see prices collapse to the downside, but then they suddenly skyrocket back and retake maybe 2/3 of the drop before then continuing down again. That's just characteristic of a volatile market, rather than the kind of steady uptrend in stocks that we saw in 2017. Trends can reverse more easily. So obviously the sentiment's a bit more volatile in itself. The sentiment is a bit more easy to change, and so while there was gradually pricing in a belief in higher prices, that can actually flip on a dime when there's higher volatility. And trading ranges will often have a less well-defined border. So in a very low vol environment, you often see this kind of rectangle pattern where there's a clearly defined horizontal support and resistance either side of the trading range. When there's lots of volatility, you can see kind of false breakouts back and forth through the range, and it makes it a little bit harder to trade. One option is to use the Bollinger Bands, which is something we're going to touch on momentarily. Just a couple of definitions here. I'm not going to go into the mathematical formula. We don't need to. It's not necessary. But just one concept is volatility tends to drop when investors are calm and rise when investors are fearful. So that was, that's what we were talking about before, wasn't it? That there's complacency in the market, and then suddenly that gets something, rather flips that into fear that, oh, whoops, we've been too complacent about X, Y, and Z. There's two types of volatility to consider here. There's historical and implied. So you'll often hear the term realized volatility. Makes sense because it's been realized. It's happened already. That's how volatile a market has been up till now. So that's obviously in the past. It doesn't tell you necessarily what's going to happen in the future. Implied volatility, or what people often use, say vol for short, that's an estimate using options pricing of how volatile a market will be in the future. So obviously that is more worthwhile, but it's less certain. What happened in the past, it definitely happened. There's no question about it. We had more price volatility in the past. Take from that what you will about what's going to happen in the future. And then for this implied volatility, it's subject to a formula which is obviously open to misinterpretation. So what's suggested about future volatility via the implied volatility is obviously not necessarily going to manifest itself, but the formula has logic. So how do you measure this volatility? For broader markets, the most popular one is the VIX. And so I've attached a chart for year to date in 2018 here, and you can see that this spike higher in the drastic spike higher in the VIX that you see is coming off the back of very low levels, where you can see over here we've got 10 historically a very low level for the VIX, and then we gradually pulled out of 10 and then went from one extreme, which was 10, up to another extreme, which was around 40 or so. And then so that was as stocks dived, the VIX spiked up, and then since then stock markets have been in a kind of choppy range and volatility has come down, but it's still elevated. So we look at it, the VIX maybe averaging around 20 now instead of averaging 10, and 20 is often a warning level of a higher volatility environment that people will pay attention to. So I've said there, above 20 considered high vol, under 20 considered low vol. And incidentally, it's based on the fluctuations in options on the S&P 500 over the next 30 days. That's what the VIX is based on. So, and more perhaps usefully for specifically looking at the markets you're trading, there's a couple of indicators I'm going to go through today. There are more, and actually in the LCD Trader you'll notice they're actually helpfully listed under a category of volatility under indicators. So you can try a few different ones of these. I'm only touching on two today. First one is Bollinger Bands, which is very popular. They're just drawn on top of the chart, so an overlay indicator. There's two bands, which are two standard deviations above and below the 20-period moving average. So just like you would have learned back in the good old days in your maths class, if you're talking about something within two standard deviations, that should capture 95% of occurrences. So basically, if the price is moving beyond one of these price bands of two standard deviations, that only happens 5% of the time. So it's telling you it's a unusual level of price movement, i.e. it's higher volatility than normal. So within the bands, with it is basically a normal range for volatility, and then outside the bands, you're in a kind of higher volatility environment. So you can see we've, we've simply circled that in this environment here, where we see a kind of low vol range trading, steady environment breaking to a sudden high volatility trend. Another one is the average true range, and again this is available in the LCD Trader. We'll have a look in just a minute. But this, sourced online, is quite a useful guide as to what exactly that is. It's based on the last two candles, if you like, depending on the time frame you're trading. It could be the last two hourly candles, it could be the last two daily candles. Typically, people pay most attention to the daily ATR. That's based on the last 14 periods, as you can see here, ATR 14. And it shows as an underlay on the chart, and you can see here as the market's in a kind of steady uptrend, but then we suddenly roll over into a sharp downtrend connection, and the ATR spikes up. So the ATR doesn't tell you which direction, because obviously you can see here the market drops but the ATR goes up. It just talks about how it's basically purely a volatility measure, not a directional measure. And then you can see here in this case the market gaps up into a new uptrending environment after being in a kind of lower vol range, but again the ATR spikes up, even though we're talking about a directional change up, and here's the directional change down. But basically, it's the greatest distance of these three alternatives relating to yesterday's and today's high and close and low are the main factors considered. So some five, I would say, top points for adjusting your trading to fit the volatility environment. So some wider stops might be needed. So obviously, if for example, going back to this page, the average true range, one of these measurements is typically 50 pips. Then you could, and say it's 50 pips for the day in some certain currency pair, for example. You could obviously be basing your stop loss around 50 pips with the general knowledge that actually it would take a whole day's worth of price range to knock you out of your trade based on that size stop. Well, obviously, if the ATR picks up to 100, then your stop loss of 50 is no longer covering a full day's worth of price range. It's now only covering a half a day's worth of price range. So suddenly you're only covered for half the amount. So what you can either do is widen out your stop, or you can take a smaller position with the same size stop. So basically keep the dollar amount or the currency amount that you're risking the same. You typically risk, you trade 2 contracts on 50 pips and you're risking $100 or $1,000. Well, keep risking $100 or $1,000, but instead of trading 2 contracts for 50 pips, trade 1 contract for 100 pips. So that way you can keep the stop size the same, but you just reduce the position size to account for the larger likely price swings that you may have to endure before you get to your profit target. The other thing is that people don't always mention, but it's an alternative in effect to points 1 and 2. If you want to keep your trade parameters the same, that's perfectly fine, but you might just find you have to re-enter your positions a bit more than normal, i.e. you'll get stopped out. That's fine. You've covered yourself for the amount of risk you're comfortable with, but you may have to re-enter the trade once the market recovers from that high volatile price swing and goes back in your direction and starts to look good again. Yeah, again, you've been stopped out, but you enter the trade again, you can still make a profitable situation out of it. One thing to note is that trailing stops, I've said may not function as well. I think that's probably true, but you can also say maybe don't function the same. So for the same reason that your fixed stop loss is more likely to get hit, the same can be said of a trailing stop. So if you're trailing your stop loss behind a 20 period moving average, for example, but actually the price swings are so large that they're swinging up and down through the 50-day moving average, then that's in, for example, an uptrend. That 50-day moving average might be a few pips below the 20. So, obviously your stop's getting hit below the 20 because the price is reacting in that higher volatile movement, reacting more to the 50. So you can either obviously just start trailing using the 50 and adjust the distance you're using in your trailing stop, or just maybe abandon the trailing stop altogether if you're not comfortable with the amount of risk that's involved in trailing it behind the 50 and the amount of profit you might give up in doing so. I mentioned the word whipsaws here. That's just kind of one-off price swings, typically counter to the normal trend that can catch you out because of some high volatile news event typically. And then the fifth last point again, which we've kind of touched on before, is that because your profit target is more likely to get hit in a closer period of time, what you can actually do is, if you're widening your stop loss, well, then naturally you actually need to widen your profit target too to make the trade still worthwhile, to have the same risk to reward. So you can actually get more ambitious on your profit targets because you can expect more market movement to carry the price further than it might otherwise have done in less volatile markets. So I'm just going to switch gear here to the LCG trader, and we'll touch on a couple of those indicators, and I'll try and kind of run through just an example of how the volatility switched around. Let's put it on full screen. So I've kind of pre-highlighted this. So this is Germany 30, so our proxy for the DAX. And so you can so this is a daily chart, and so obviously the most interesting thing of late has been the market crash that we've had, where there was obviously a sudden spike in volatility, and you can see it. This one was just so marked that you can see it quite clearly on the average true range down here and on the Bollinger Bands, which are on the chart. So if I just show you how I got those indicators on there, right click on the chart, indicators, and then you can see here there's a whole bunch of indicators that are somehow showing you some measure of volatility. So helpful enough, I think. Trend, obviously for a trending environment, you're using these indicators. Oscillators typically for a more range-bound environment. Volatility to judge volatility, volume to judge volume, and then just things that don't fit in any of those categories. So, so then you can see the Bollinger Bands there. And then you can see average true range is there. I've just left them as the default settings. So the size of the ATR will obviously vary according to the market you're looking at. This is the stock index, and so you can see here that actually I've marked in 100 and 200. So roughly speaking, so the average true range is not quite the same as the true range of a day. So the high to the low of the day, it's based on those relationships involving the close as well, as I showed you in that slide. But roughly speaking, a daily price swing of around 100 points is fairly low volatility for the DAX. And so actually when you start getting an average under 100 for a prolonged period of time, so for 14 days typically, then you know you're in a bit of an excessively low volatility environment. Equally, periods above above 200 points in a day for the DAX typically characterize these high volatility environments. So, you know, you see the same thing happening here. You'll notice that both of these indicators are somewhat lagging, but more so certainly with the ATR. So you can see a couple of examples here where the market suddenly started getting a bit volatile in a kind of this is a good example of a kind of volatile range environment where these lows and they're not really being respected and the highs are not really being respected, but the price isn't going anywhere. And you can see that the volatility was getting very, very low based on this kind of a very steady price action in the past, and then eventually caught up with this action that was happening here and spiked up. Particularly when we had this final, this big candle here. And then likewise over here, you can see the Bollinger Band pretty much captured it straight away. Obviously, this is a fairly classic example of a, just we had a trading range here. Price broke to the top side. So it had been very small range days. And then suddenly we had a big price range day inside the range. And finally we got the breakout, and it pushed above the breakout of the price range and the Bollinger Band, showing us that we're now in a trending environment. So with that high vol moment, and then it actually steadied out into a more typical rising uptrend with most of the price movement captured within the Bollinger Band. So we were trending higher, but actually you can see here based on the ATR, actually while it reached an extreme low in volatility there, it picked up, but it wasn't extreme over here. It was actually just above what might be considered a kind of low volatility environment. So it was a steady uptrend, right? So here we had a volatile range. Here we had and here we had a steady trend. So it doesn't, and then obviously over here we have a volatile trend, and you can also obviously get a more steady range trade environment as well. I wouldn't probably classify this particular period as particularly steady. You're more talking about this kind of period, I suppose, is the example of a steadier trading range. Good question, Conrad. Yeah, so you literally just the same way you would on the price chart. So say I'm chucking in a line here, you can do the same thing. Can I actually drag it down? No, I can't drag it down, but I can click on the horizontal line tool and then just chuck one wherever I like within the indicator. And you can do that with most of the technical indicators. Actually, you can just draw yourself in a line. even if you're using the RSI or the stochastic or something. You can draw in these lines, or the alternative sometimes, to be honest, I haven't pre-planned this, modify indicator. Oh, there you go, levels. So if you're going to consistently use a certain number of levels, you can have them just typed in here. So you can actually just type in 100 there. And then if I actually deleted this line, there you go. It's actually there. So it's another way of doing it. I think maybe the reason I didn't do that was that, you tend to have a saved template, and what's 100 may be relevant for the DAX, but it's not relevant for euro dollar, for example. Okay, so yeah, just got a question from Ezel here. So just asking about, well, so the thing is, I suppose always with these kind of news events like Trump's tweet talking about that Russia should be prepared for some missiles in Syria. Obviously, it's if we were in a very low volatile environment right now, then that would obviously be a complete shock, that statement, and you'd see a pretty vicious reaction in markets. I think, looking at obviously the current state of the DAX and the daily candlestick today, and then just what we're looking at in terms of an open on Wall Street, you can see that the market's not liking it. In the general context of things, there are obviously other factors at play, but I wouldn't say it's a positive for markets. But you're not seeing any dramatically lower day so far. Now, obviously, Wall Street hasn't opened yet, so you tend to see maybe a negative pre-market, which can obviously escalate quite quickly once the real market's actually opened. But for the time being, based just on what we're seeing in Europe, which is obviously a lot closer to Syria than the US is geographically, you're not quite seeing the panic reaction. So that to me is just a function of the environment we're in. We're used to some really volatile up and down price moves, and we've been digesting the fact that maybe a trade war with China is slightly less likely, given that both sides trying to be a bit more conciliatory. So maybe Trump's just bringing them to the negotiating table. So if that's a factor, then you've got to think that maybe this situation with Syria is not going to have such a dramatic effect if you've got that kind of positive background to it, and the fact that we're just getting a bit more used to these kind of volatile geopolitical things, which perhaps we weren't as used to just a couple of months ago. So I mean, it's certainly just talking more broadly about how to deal with the kind of current environment we're in the indices. Clearly, looking at, say, the trend we had at the end of last year, it actually ended a bit sooner in the DAX, and I was actually warning about it at the time that we seemed to have a bit of a sideways double topping situation going on in the DAX, while Wall Street was still heading higher. So is the DAX, does it need to catch up, or is it actually a forewarning of what could be about to come for US indices? So proved to be the latter in the end. But if you've got I'm trying to find some better example. This is really the better example, where you got actually fairly minimal, got a kind of steady trend to be dealing with, and fairly minimal size price days. Then it's actually a lot easier to trade with a smaller account or with smaller stop loss sizes. Looking at these smaller price swing days, the bigger price swings tend to be actually in the direction of the trend, with a couple of exceptions, obviously. So there's less room to be caught out. As we currently stand, you can see that the typical daily price swings have been very big, not quite at 300 anymore, easily above 200. So I think if you are trading off a daily chart, for example, trying to trade for the next few days to capture some general trend direction, which is obviously the kind of thing that I talk about mostly in my weekly webinars, you've got to have a fairly wide stop at the moment to be able to do that. Or I would say that, so the caveat to this go for the normal opportunities you'd normally go for with a wider stop and a smaller position size, or you just have to be extra selective. So, you know, this would be a sort of prime example here where we're in a trading range. You know, we've got a bit of a kind of maybe a downtrending situation here, but you've got some fairly flat lows, and then you see a sell-off here on the day near the trend line, and you think, well, you know, we're not quite at the top of the Bollinger Band. We're not quite at the top of the price range based on support and resistance. You know, we're not quite up here. But, you know, I'll just go with this trend line. Well, you know, obviously with the benefit of hindsight, we now know that actually it would have been better off waiting, you know, higher up into the range for the, you know, when you're selling, you obviously want the highest price is the best price. So waiting for that better situation, the slightly higher odds situation, just to account for the fact that the volatility is higher. And so in this case, obviously, depending on where you put your stop, maybe if you went for it at the moment based on these closes, you could have your stop above the highs and it's not as bad, or you have it somewhere within the wicks of these candlesticks, you know, in a stop loss just not too far above. You know, your risk obviously is not as wide as if you'd gone for the more aggressive entry down here. So it's that kind of stuff. I think you just have to be a bit more selective and just be very much aware that we're not in a trend right now, right? So don't use a trend line. We're in a range-bound environment. Of course, this could have worked. It could have rolled over to new lows, but, you know, the odds were it wasn't going to. So be aware of just the environment. The trend we're in, there is no trend right now. It's a range, and it is a low volatile or high volatile range. You know, it's a high volatile one. So trading anywhere within the middle of this price range is pretty high potential reward, because it could just spike straight away in your direction, but a high potential risk because it could just as easily go the other direction. So how are we doing for time? Yeah, we've hit the half an hour mark. So guys, I'm going to leave it at that today. I hope that kind of did expand your repertoire a little bit on volatility, and I hope it was useful for this environment, which is pretty high vol. All right, thanks everyone. Thanks for attending. Jasper signing out.